This is the CQA Investment Challenge pitch video for Vanderbilt University's Owen Graduate School of Management team. We will begin by introducing the team members. Next, I'll cover our team's investment philosophy and our investment process. Our team leveraged the market research signals product significantly during our investment screening process. With the help of our team mentor Bola, our team took a top-down approach to choosing the specific factors that we thought would perform best over the next 5-month holding period. We first reviewed all the factor groups that are provided within the markets tool and excluded the factor groups that we felt would not be good indicators of a stock's future performance. After this screening process, we arrived with 4 factor groups that we would dive deeper into. Most of our team members have a value-oriented philosophy in our personal investing activities, and we've learned that stocks with attractive value characteristics tend to perform better over time. Thus, we included the relative value and deep value factor groups in our analysis. With the rise of high-frequency trading and automated trading algorithms now driving a large portion of market volume and in turn stock return performance, our team also wanted to include price momentum factors in our analysis. Since a company's financial performance and earnings are key drivers of a stock's price, we wanted to capture this as well by incorporating earnings momentum factors. The timing of earnings season and the beginning of the CQA Investment Challenge was another reason why we thought adding earnings momentum factors to our customized model would be a good decision. Using these 4 factor groups, our team relied on the information coefficient and decile spread statistics to guide us in selecting the best individual factors. We chose the information coefficient statistic because of its ability to indicate factors that have a high correlation between predicted and actual stock returns over specific periods of time. Our team also chose the decile spread as a second differentiating component to our analysis because we wanted to select factors that had a large difference in returns between the first and 10th deciles. Our thought process was that since this is a beta-neutral competition, if we chose factors that had the largest difference between returns when we went long companies in the first decile and short companies in the 10th decile, our portfolio would gain an additional benefit than if we had just used the information coefficient. When our team screened the 4 factor groups by the IC and decile spread statistics, we came up with 4 relative value factors, 5 deep value factors, 5 price momentum factors, and 3 earnings momentum factors that we would combine in our customized model. Now I'll cover our team's portfolio construction and trading strategies. Our team incorporated the 17 factors mentioned before into a custom-built portfolio and screened the market U.S. large-cap universe. After the screen, our team analyzed the companies in the first decile and selected 10 stocks to go long with, and an even amount was invested in each one, usually roughly 5% of the portfolio's value. Then our team went through the bottom 10th decile and selected a group of 10 stocks to short in even amounts, roughly 5% of the portfolio's overall value. Our team selected these individual stocks due to a combination of methods including whether a member had specific expertise in the stock sector, an overall long view of the healthcare and real estate sector, and an overall short view of the technology sector. Our team revisits the portfolio construction on a weekly basis by rerunning the market tool and making sure that our long and short positions are still within the first and 10th deciles respectively. If a specific position falls outside that range, then our team will analyze whether or not to close the position and move into another position within the first or 10th deciles. Our team will also meet and analyze potential investment opportunity that is brought up by one of our members regarding a stock outside the deciles. But adoption of these ideas will only be done in special situations due to our primary goal of using the market tool as our investment criteria. Next, I'll cover our team's risk and return expectations for our portfolio. Given that the competition requires that our portfolios are market neutral, the source of portfolio return and risk will be independent of the market swings. The alpha of the portfolio will come from the ability and skill of our team to short sectors and specific companies that will perform poorly over the next few months and go long the sectors and companies that we feel are well positioned to move higher. The market neutral requirement will also most likely make our portfolio's returns much less volatile than the general markets. Our team is hoping that the market returns over our investment period are not highly correlated, and there is a significant gap between the best and worst performing stocks, which both lend themselves better to market neutral strategies such as the one we are using. Lastly, I'll cover our team's portfolio attribution methods. For our team's portfolio attribution analysis, we will compare our portfolio return to the return of the SPY ETF return. We will also attempt to break apart our alpha or excess return into specific effects. Those effects would be a weighting effect, a selection effect, the interaction between stocks in our portfolio, and a residual. Through the use of StockTrack and the Axioma tool, we will attempt to break apart our alpha. The weighting effect refers to our team's decision to overweight or underweight specific sectors. The selection effect refers to our team's stock picking skill. And the residual is the portion of the excess return that cannot be explained by the holdings composition at the beginning of the holding period. We hope that you've enjoyed our team's presentation, and we are looking forward to the next several months of the competition. Thank you.